start recording this. And I think this was kind of explained in the PowerPoint, so hopefully you had a chance to watch that PowerPoint. So we have some going through some of the assignments here, and I think you're at an advantage because you're taking income taxation concurrently with the Intermediate Accounting 2 course, and so in that way, perhaps some of this will make more sense to you. In a way. Okay, so we're talking about differences. So we're told here that in 2021, we have pre-tax accounting income. So this is book income, right? This is income from the income statement, okay? So I'm just gonna write here, this is from income statement. Okay, the income statement. So this is income, actually I should say income before taxes, right? This is income before taxes, all right? And then usually on the income statement, we have income from income before taxes, then we have our income tax expense, and then we have our net income, right? And so this is the income before taxes. We're also given information regarding taxable income. So taxable income, as we said, comes from the tax return. Since we're talking about a corporation, corporations file Form 1120. Okay, so we're talking about the income tax return 1120. And on that 1120, we have taxable income. Now, in the income taxation course, we've been covering the individual income tax formula. The formula for the corporation is similar, except that the corporation is not going to have, the 4 AGI adjustments, and from AGI adjustments, the corporation doesn't even have adjusted gross income. So they just have income and tax deductible expenses. That's it. So maybe it's less complicated, the calculation in arriving at taxable income, than it is for the individual. And so we have taxable income is 21 million. So we can see that there is a difference between our income on the income statement and our taxable income, right? So in this case, our taxable income is less than our net income per our books, all right? So what that means is that we had a temporary difference, all right? We have a temporary difference because they told us here that we have a temporary difference. And what we mean by temporary is that it's going to affect this change, this difference here is gonna reverse in the future, okay? It's gonna affect future periods. Because it's going to affect future periods under the FASB codification, we're told that we have to accrue, we have to estimate these amounts, and we have to accrue it and show it on our financial statements. Okay, so that's what we're doing. The only items that we're going to be analyzing and reporting on financial statements is going to be temporary differences, not permanent differences. All right. And so in this case, so let me just write a note here. So if we have our book income, it's greater than our tax income, okay, this looks like a deferred tax liability. Okay, so meaning we benefited, we paid less taxes, all right? If there was no difference, we would have paid taxes on 38 million. But we had a tax deductible item, we weren't told what it is, that reduced our taxable income to 21 million. So we're only paying taxes on 21 million. So this difference benefit us. We're paying less taxes in 2021. However, because it benefit us in the current year, and we're told it's temporary, it's going to reverse in future years. That means that we're going to have to pay more taxes in future years. And so future taxable amounts is the definition of deferred tax liability. The reverse is true. If our book income, is less than our taxable income, which means that we're gonna pay more taxes today, this year, then that means that it's gonna reverse in the future, and these are gonna become deductible amounts. And future deductible amounts is the definition of deferred tax assets. Okay, so as long as we understand that, maybe that will make more sense. I like to set it up as we have our pre-tax accounting income of 38 million. And then we have our temporary difference, which we deducted for tax purposes. So the difference between 38 and 21 is 17. Okay, and we're talking millions. 17 million. And we arrive at our taxable income of 21 million. Okay, so now taxable income, we use it to calculate our income tax payable. Okay, so they told us the rate is 25%. So if I take 21 million times 21% is 5 point, wait, too many zeros. 21 million multiplied by 25% is 5.2 million, right? So this is going to be my income tax payable. This means what is actually due to the tax authorities. Okay, this is how much taxes I will report on my Form 1120, and I will have to redeem to the tax authorities. All right, now we have to calculate the cumulative effect of this temporary difference. So we take the temporary difference and multiply it by the 25%, and that's 4,250,000. Okay, and this is our, we said, deferred taxable liability, because we pay less taxes in the current year, but we're gonna, this difference will reverse, and we're gonna have to pay more taxes in the future. So now we can go ahead and design our journal entry, because the beginning balance of our, they told us there were no other temporary differences. So the beginning balance of our DTL account was 0. So the full adjustment of our DTL journal entry will be the 4.2. So we're going to have a debit to income tax expense, which is a plug figure, okay? And accountants love that word, okay? And so we have our deferred tax liability of, in this case, 4,250,000. Oops. Okay, and then we have our income tax payable of 5,250,000. So then we have our income tax expense of 9,500,000. Okay, so that's the journal entry. Any questions? Okay, we have Cara Fashions uses a straight line depreciation for financial statement reporting, and Makers for income tax reporting. So 3 years after its purchase, one of Cara's building has a book value of 640,000 and a tax basis of 480,000. There were no other temporary differences and no permanent differences. Taxable income was 6 million. Cara's tax rate is 25%. what is a deferred tax liability. However, our deferred tax liability now has a beginning balance. Okay, it has a beginning balance which we need to take into account when preparing our journal entry, when formulating our journal entry. Another twist to this story is that we were given book value, right? Where does the book value come from? Where do we get the book value from? Book value, where do we get that from? For a building, for an asset, for a plant asset, for property, plant, and equipment, where do we get it from? We get it, thank you, Paula. We get it from the balance sheet, okay? We get it from the balance sheet. So basically, our book value, let me just draw a line here. So book value is going to be our cost, right? Less our accumulated depreciation. That equals book value. Okay, that equals book value of the asset. Tax basis is the same. Tax basis is going to be the cost less any prior depreciation deductions. Or if you want to translate that, that's basically our accumulated depreciation. Okay. So it's virtually almost the same, except that the accumulated depreciation will be different because for tax purposes, we are using an accelerated method called MAKERS, okay, which we are going to be looking at in our income taxation class. We haven't really covered this yet, but not much to it because you don't have to actually do any calculations except for using the percentages that they might give you every now and then. And so it's an accelerated method. And for book purposes, we're using straight line depreciation. Okay, so there's going to be any problem that talks about depreciation, lights should go on and off, letting you know that this is a deferred tax liability because for tax purposes, we're allowed to deduct a higher amount than we are for book purposes most of the time, okay? And so you will assume that this is going to be a deferred tax liability. So we weren't given our pre-tax accounting income, but we were given our taxable income. We could actually calculate it, our pre-tax, but I want to kind of cover what are we talking about here? Maybe that makes more sense. And I kind of made some numbers up. So let's assume, so we have, let's say we have tax basis and we have book value. Okay. So let's say we said it was cost. So let's assume the cost is 700,000. Okay. So 700,000. All right. And then we were told that the tax basis, tax adjusted basis is 480. And then book value was 640. So if I wanted to find out what the accumulated depreciation were, for tax basis, I'm just going to take the 700,000 and find the difference between that and the 480. So I have 220, okay? And then here we have, what is it, 60,000? So we can see that for book purposes, we only deducted 60,000 of depreciation expense, but for tax purposes, we depreciated 220. In essence, the difference between these two is gonna give us a hint about our temporary difference, which happens to be 160,000. Okay, this is our temporary difference. We said since we're talking about a difference in depreciation where tax depreciation is greater than book depreciation, then we're going to have a deferred tax liability. Okay, deferred tax liability. And so the problem here is that we have a beginning balance in deferred tax liability. So if I were to take 25%, so multiply by 25% of the effect of this difference, I get 40, right? 40,000 of DTL. So this was the question over here. So that's 40,000. So if I had my T account, if I have my beloved T account for our deferred tax liability, okay, and of course debits and credits, and we have a beginning balance in this account of 26,000, and the ending balance, this indicates the ending balance. The ending balance is supposed to be 40,000. That means that I had to credit the difference in order to increase that from 26 to 40, and the credit to that was 14,000. So that means that I'm going to have to include this 14,000 in my journal entry. Now the last calculation will be my taxable income multiplied by 25%, because this is our income tax payable. So 6 million times 25% is 1.5 million. This is our income tax payable. So this is the amount of the check I'm going to have to write to revenue and tax. Okay, that's what income tax payable means. And then our income tax expense is just a plug. So we're going to have income tax expense, a debit, of course. We have a credit to the deferred tax liability of 14,000. And then we're going to have a credit to income tax payable. And we said that was 1.5 million. So it looks like income tax expense is going to be 1,514,000. Okay, so that's our journal entry, our evaluation, and that's it. That's it for that one. Okay, here we have another one. There's a slight difference on this one. Okay, so we have our pre-tax accounting income is 34 million. We have just one temporary difference. We have taxable income of 36 million. Now, instead of paying less, as we said before, we are going to pay more for taxes. Okay, there's no beginning balances on anything. Since we are paying more, what that means is that this is going to be a deferred tax asset. So I pay more today. It means in the future I'm going to pay less, and therefore that works to my benefit. This is a deferred tax asset. So the difference between the two, I could do it the same way as I did the first one, where we had our pre-tax accounting income of 34 million. We had our temporary difference. In this case, we're adding, right, 2 million to come out to our taxable income of 36. Okay, can't talk. 36 million. Okay, and so first of all, we have to multiply 36 million by 25%. That's our income tax payable. So 36 times 25% is 9 million. This is income tax payable. And then we were told there were no beginning amounts for deferred tax assets, so we don't have to worry about that. We just take 25% of the 2 million, which is, I should know this, 500,000. And so this is going to be our deferred tax asset. So this is a different entry only because we have an asset instead of a liability, but everything else is the same logic. So we have our income tax expense, which in this case is going to be 8,500,000. We have our deferred tax asset, just like any other asset. We are going to debit if we want to increase the asset, or credit if we want to decrease it. And then we have our income tax payable for 9 million. Ta-da! Okay, nothing there again. All right. Next one. In 2021, Ryer Management collected rent revenue. Okay, rent revenue, it's a typical deferred tax asset. All right, because for book purposes, we are going to defer the revenue, okay, when we receive cash. Usually the entry that we have for book purposes, so this is going to be book, right? We have a debit to cash and a credit to deferred revenue. And we know deferred revenue is a liability. Okay, so this is to recognizing no income, no revenue for book purposes. But for tax purposes, Uncle Sam says you received the cash. Therefore, I should be able to get a tax payment from you. And so for tax purposes, this cash that we received in advance is going to be included as income, taxable income, and taxed. Okay. Since we are taxing it today, in the future, that difference will reverse to our benefit. We are going to benefit from this. Therefore, this is a deferred tax asset. And I think your textbook has a table of, I guess, most used deferred tax liabilities and deferred tax assets. So maybe you want to, kind of keep an eye on that table as you're doing the assignments or trying to understand this topic. Okay. All right. And so for financial reporting, the rent is recorded. Okay, that's exactly what I just said. The deferred portion of the rent collected was 74 million. So we collected 74 million in cash. So you could write here the numbers if you wanted to. Okay, so this is the entry for book purposes. But again, for tax, we are going to recognize the tax. Taxable income is 300 million. There's no beginning balances. So the full, what do you call this? The full effect of this difference is going to be part of our journal entry. So we're going to take 74 million and then multiply it by 25%. So we get 18.5 million. And as we said, since we're paying more taxes today in 2021, then later on it's going to reverse. So this is a deferred tax asset. Okay, and then we have to calculate our income tax payable, which is the 300 million multiplied by 25%. So we have 75 million is our actual amount due to the government. So we're going to say income tax expense XXX. We don't know that yet. And we're going to have a debit to our deferred tax asset for 18.5. And we're going to have a credit to income tax payable of 75 million. So the difference between the 75 million and the 18.5 or 56.5 million is going to be our income tax expense. Okay. All right, we have Shannon Polymers. What a name. Okay, Shannon Polymers uses a straight line depreciation for financial reporting purposes for equipment costing $120,000 with an expected useful life of 4 years and no residual value. Okay, so it looks like we have to calculate the depreciation here, which is fine. Okay, assume that for tax purposes, the deduction is 40, 30, 20, 10% of the basis, right? So it looks like we also have to calculate the tax depreciation. Pre-tax accounting income, the first year the equipment was in use. Okay, so pre-tax accounting income is 940,000, which includes interest from municipal bonds of 27,000. So what do we know about interest from municipal bonds for tax purposes? They're tax exempt, right? They're excluded from taxation, all right? So this is going to be, and they're forever excluded, which means that this is going to be a permanent difference. So I'm going to put a P here, while the depreciation is just a temporary difference. And what did we say about deferred tax assets and liabilities? We only need them for what? What do we use? When do we need to accrue these deferred tax assets and liabilities? Based on what? What have we been discussing since the beginning of class today? Differences in book and tax income that are what? Temporary, correct, temporary. Okay, differences that are temporary, exactly, okay? So the permanent difference is there to calculate taxable income, but the deferred tax assets and liabilities are only analyzed for temporary differences, all right? So we have our pre-tax accounting income. So I'm gonna just write that, do that analysis first. Pre-tax accounting income. And we were told it was 940,000. Okay. Now we also, even though the permanent difference is not going to be a part of our deferred tax assets or liabilities, we still have to account for it in calculating our taxable income. So if the income was included in the 940, it was added to the 940, or in arriving at 940. For tax purposes, it's excluded, so we're going to take it out. And then we have our temporary difference, and I should probably do a side on the side calculation here. So we have, first of all, book depreciation. it's 820,000 divided by 4, right? So 820 divided by 4 is 205 of book depreciation, okay? And then for tax depreciation, we have 820,000 and then multiply by 40%. So 820 multiplied by 40%, we get 328,000 in 2021. This is our tax depreciation, okay? So we're gonna have our temporary difference, and we have our book depreciation is 205. Our tax depreciation is 328. So we can see that tax depreciation is higher than book. So we said we are going to have a deferred what? What do we have as a result of this temporary difference? Do we have a deferred tax asset or a deferred tax liability? We have DTL, yes. We have DTL, okay? Because we're benefiting from this deduction in 2021. We're paying less taxes, but this difference is going to reverse in future years, which means that we're going to pay more taxes in 2022, 2023 for the next 4 years or 3 years, the next 3 years, right? Therefore is a deferred tax liability. So 940 minus 27 minus 123 is 790. Maybe someone can confirm that for me. So that is our taxable income. So we said in order to calculate our income tax payable, we take our taxable income, multiply by 25%, and we get 197,500. This is our income tax payable. We had no beginning balances for the deferred tax liability. Let me just enclose this so it gets out of the way in a way. Right, so the full effect, the full tax effect from the temporary difference will be journalized. So 123 multiplied by 25% is 30,750. So now we are ready to do our journal entry. Isn't this a great exercise for the exam? I think it's great because it includes all aspects, and it can really show how you understand how the temporary difference originates from. Okay, and so we have our income tax expense, and then we have our deferred tax liability of 30,750, right? And then we have a credit to income tax payable of 197,500, and then our income tax expense is going to be a plug figure to make this balance, right? 228,250. Okay. All right. I think in the PowerPoint I indicated that we were looking at net operating losses carry forward only. We're not gonna do anything with carry back. Carry back, I think I explained there was several changes in the law. So there was one introduction with the TCJA of 2018, where we were told that we were only allowed 80% of the deduction for net operating losses. But later on for, what do you call this? With the pandemic, they increased it to 100% again. So it's been like back and forth, different topics. So we're just gonna do, which is the easiest one. It's the carry forward. We'll just put a pin on that carry back. I think if you are interested in CPA examination, you probably want to take a look at the carry back. But for now, for this class, we're just gonna do the carry forward. So we have that during its first year of operation. So do we understand what's a net operating loss? What is your understanding of a net operating loss? What does that mean? Well, it could be, yeah, of course, it's going to be from, what income we're including in our tax return, what deductions are we claiming, but what does it mean exactly? Oh, okay. Um, um, Taxable income or taxable loss is not the same as cash. Yes, we're reporting on a cash basis, sort of. I guess a modified accrual basis for some corporations and larger businesses, but it doesn't really necessarily match exactly with your cash inflows and outflows. So whether we lost, we could report a net operating loss, but doesn't really mean that we and I guess, yeah, maybe the confusion is there. The net operating loss, we're talking about tax, right? We're talking about a tax net operating loss. And it doesn't really equate with making a profit, because when we calculate profits, most of the time we're using accrual basis, especially for these corporations, as the book, concentrates on. So when we're talking about, so let me just represent the little formula for corporation tax formula. And don't worry, I'm not going to bore you to death. We have our gross income, right? Less any excluded income for tax purposes. And then we're going to have less our tax deductions. So deductions that are allowable for tax purposes under the tax law. And then we arrive at taxable income. So it's a lot more simplified than individual income tax returns. When I was working as a professional, I always pray for corporation income tax returns than individuals, because corporations, if you have audited financial reports, it's like a straightforward income tax return compared to an individual that have all these, shoebox kind of forms. It's just a nightmare. So it's much more easier, the corporation, in terms of, doing the tax return than an individual. So in this respect, when they're saying net operating loss, that means that their tax deductions, the deductions that were allowed on the tax return, are greater than the income that was taxed, the taxable income. All right. And so we ended up, instead of a taxable income, they ended up with a taxable net operating loss. So we abbreviate that by calling it NOL. Okay, so when you see NOL, that's what it means, net operating loss. And this operating loss it's not something that they just lose the benefit from it. They can carry forward and use it to offset. So let's say that, okay, let's make up some numbers so maybe this will make more sense. So let's say we had income less any excluded income of 700,000, and we had deductions that were allowed on the return of 800,000. So we ended up with a taxable loss or NOL of 100,000. So this is, let's say, 2021. All right. And so what we're saying when it comes to 2022, if we happen to have taxable income, let's say of, I don't know, 200,000, then we can use this NOL to offset a portion of our future taxable incomes. Okay, so we're gonna benefit from this net operating loss because this represents future deductible amounts. Then this is gonna be a deferred tax asset. Of course, we hope that in the future we're gonna take advantage of this. And so before it expires, which is 20 years, and so therefore, this is a deferred tax asset. All right, and so in this case, we're supposed to come up with a journal entry. We're told that the NOL is 7 million. So we need to find out what the tax impact of this is. So if we take 7 million multiplied by 25%, that's 1.75 million. So this is going to be our deferred tax asset. So we're going to, I think there was zero balance at the beginning of the deferred tax asset account. At least they didn't really tell us anything. Oh, they told us it was for year of operation. So of course it's going to be zero balance. So debit our deferred tax asset for 1.75 million, and then credit income tax expense. They should probably credit income tax benefit, but your book wants to do it this way, so we'll do it this way. Okay, so it nets up to being the same thing. We're basically reducing the income tax expense by the tax benefit of the deferred tax asset. All right, so ta-da, that was it. Okay, next. Southeast Airlines had pre-tax earnings of 85 million. So this is their book earnings. Included in this amount is income from remember this? You probably, don't tell me you forgot about discontinued operations. And then the company tax rate is 25%. What is the amount of income tax expense that Southeast would report in its income statement for continuing operations? Okay, so they're telling us that the discontinued operations are included in our pre-tax earnings. So if you recall, we had our multiple step income statement, and we start with our continuing, maybe I should put that on this side, right? We have our let's start with net sales. Net sales, we had cost of goods sold, we had our gross profit, we have our selling expenses, we have our general and administrative expenses, we had other income and expenses from peripheral activities. We had our income from continuing operations before taxes. We had our income tax expense, and then we have our income from continued operations after taxes, something like that. And then after that, we had, if we had discontinued operations, and these were net of taxes, right? And then we finally had our net income, and then of course our earnings per share, et cetera, right? So if you recall, we were separating what was continuing operations from discontinued operations, if we had discontinued operations. Since we are already reporting the continued operations net of taxes, we need to do the same with our discontinued operations. So in this case, since they're only asking for continuing operations, we need to break down what's continued operations and what is discontinued. So basically, 85 million is the total. So we're gonna subtract the 15 million for discontinued operations to arrive at our income from continuing operations, right? Which is 70 million. And then to find the income tax expense for that, we are going to take that 70 million and multiply it by 25%. What is the tax rate, by the way? What is the tax rate for corporations? Do we know? %21%. It's a flat rate, so they don't have graduated rates like we do for the individuals, where you had all those different tax brackets depending on income. They used to for the corporation, but starting in 2018, they have a flat rate of 21%. Why your book is using 25, I have no idea, but yeah, there we go. All right, and so we have our income tax expense from continuing operations. So maybe we can do that part of the income statement. So we have income from continuing operations before taxes. That will be the 70 million. Our income tax expense of 17.5 million. So after tax is 52.50. Oops. And then we have our discontinued operations net of tax. So we can take 15 million and multiply by 75%, or 1 minus 25%. So 11.25 million. So our net income is $63.75. Okay. So I think that was a refresher from BA 300. Okay. On January 1st, 2018, Amin Company purchased major pieces of manufacturing equipment for a total of 42 million. Okay, this is very similar to what we did, right? Oh, maybe I know. There's a twist here, because they didn't actually told us what the beginning balance was. They're just telling us to calculate it. Okay, so I got it. All right, so we have Amin Company purchased major pieces of manufactured equipment for a total of 42 million. They use a straight line depreciation and makers for income tax. Okay, so we have a DTL. If we're talking depreciation, we're talking DTL. Okay, we have an accelerated method for tax purposes. We have a straight line for book. All right, we're told that on April 30th, 2020, book value was 36 and the tax basis was 26. So there's a $10 million difference in 2020. $10 million difference multiplied by 25%. So make sure you multiply by 25%. I think sometimes students make mistake of just taking the difference and they forget that we're only interested on the tax effect of that, of the difference. All right. So this actually is the beginning balance of our deferred tax liability. And then we are given information about the current year. Book value of the equipment was 34. Tax basis was 19. So the difference here for 2021 is going to be 15. Okay. So 15 million multiplied by 25% is 3.75 million. All right. So this is the ending balance. This is what the ending balance of DTL account is in 2021. So whatever adjustments we make, they need to be made in order to end up with a balance in the DTL account of 3.75 million. Okay. So, and we also need to calculate pre-tax accounting income of 15 million. And we were given taxable income? No taxable income. Okay, so it looks like we have to calculate our taxable income. So we're gonna start with pre-tax accounting income of 50 million. We have a temporary difference of 3.75, which reduces, right, is a benefit that we're taking in the current year, but that is going to reverse in future years. Oh, I'm forgetting the previous difference here. 3.75. So we said 3.75. So that was 10 minus 15. Oh, okay. Sorry, guys. 10 million minus 15 million. So our tax deduction is 5 million for the current year. Okay, so this is in 2020. This is cumulative. Okay, this is cumulative in 2021. So we have a net increase of 5 million, which is gonna be deducted in calculating our taxable income. So taxable income is 45 million. Okay. And then taxable income multiplied by 25%. So 45 times 25% is 11.25 million. That's our income tax payable. Okay. All right. And so I think if we take 5 million times 25%, yeah. If we take 5 million and multiply by 25%, that's 1.25, which is, I think, the adjustment that we need to make to our deferred tax liability account. So basically, if we do an analysis of the DTL account, Okay, so we're gonna have our beginning balance was the 2.5 million. Our ending balance needs to be 3.75 million. So that means that we increased it by 1.25 million. Okay. So now we are armed with all this information. We can do the journal entry. We debit income tax expense. We don't know yet. We credit our deferred tax liability for 1.25 million. We credit income tax payable for 11.25 million. Is it 11.25 or 11.2? I think it's 25, right? And then our income tax expense, it's gonna be 1250. Okay. And I think the last question, number 2, is asking what our net income will be. Well, if we're looking at net income, we have our pre-tax income, which is 50 million. We have our income tax expense of 1250 million. And so this will be our net income. Oops. Okay, so that answer number 2. Lance Loan Services reports warranty expense. Okay, warranty expense is DTL. Okay, warranty expense is DTL because if you recall chapter 13, warranty expense is based on an estimate, right? It's an estimate. Do we recall what the journal entry was to estimate the warranty expense? What do we debit and what do we credit? Right. Okay. So we debit warranty expense, we credit warranty liability, and this was a probable future obligation, fully based on estimates. Okay, it's kind of like our best educated guess of what this is going to be, of the cost of fixing. This is manufacturer's warranties. Now, we deducted this expense in calculating our pre-tax accounting income. But for tax purposes, they're saying that's good that you estimated, but we don't care what you're estimating. You could estimate whatever you want to. We are only going to allow you the deduction when it's an actual expense. Okay, so that's the difference between book and tax purposes. So that means that this is going to be an add back to our pre-tax accounting income in calculating taxable income. It's going to make our taxable income higher. What am I saying? This is not DTL, this is DTA. I just answered my own question because I just said that you're going to have to pay taxes. So if you're going to have to pay more taxes, that's going to be a deferred tax asset. More coffee for me. Okay, and so warranty expense, again, deferred tax asset. All right, because we're going to pay more taxes because for tax purposes, the deduction is not allowed until you have actual expenses. So once again, they've given us the beginning balance for deferred tax asset. And then for 2021, we're told the liability is 2 million, taxable income of 75 million. And they want us to calculate the journal entry. Okay, so we want the tax effect of the difference, which is 2 million. So 2 million multiplied by 25%. And what did we said that was before? 500,000? 500,000. So the ending balance of our deferred tax asset should be 500,000. So if we were to do our T account for DTA, since we did it so many times for DTL, might as well do it for DTA. Okay, this is an asset. That means that debits increases asset and credits decreases it. We start with a beginning balance of 459,000. Our ending balance is 500,000. Oops. And so that means that this needs to be increased by 41,000, I think, if my math is right. And so then we need to calculate our income tax payable. We're told that taxable income is 75 million. So 75 million multiplied by 25% is going to be 18.75 million. Okay, so our adjusting entry again, our income tax expense, we'll leave it blank. Remember that deferred tax assets are debited, and we have an increase in the asset, so for 41,000. And then our credit to income tax payable of 18.75. So that means that our income tax expense is going to be huge. 709 compared to the 41,000. Okay, so there you go. That's our journal entry for the deferred tax asset. Okay, I think we already did this, right? Didn't we do this? Oh, okay, it's a different company. It's not Southwestern Airlines or something. This is Southern Atlantic Distributors, but it's pretty much the same concept. We purchased a truck. They gave us the value of the asset. They told us that we have to take straight line depreciation for 4 years. They gave us the maker's tax rates, which these are not exactly makers, but it's okay. We'll go with it. The maker's, the tax depreciation. So this is pretty much like, it's exactly like the problem that we did previously, except that they're just using a different amount, I think. We have our pre-tax accounting income. We have a permanent difference, which is the interest from the municipal bonds. So this is permanent and this is temporary. And we're only calculating, since we're talking depreciation, this is going to be DTL. Okay. And I don't think there's any beginning balances in DTL, so this is pretty straightforward. Okay. So I've been talking for an hour. My throat is